India's inflation accelerates more than expected in data out today, while industrial production growth for January exceeded economists' expectations. Looking at this data and more coming out of India, I'm joined by market analyst with Squawk, Anthony Barton. Welcome, Anthony. So, of course, in light of today's inflation release, what are the key takeaway points?
So on the back of today's takeaway points, really today's release came in at 5.37%, which was slightly higher than expectations. One of the key drivers in the modest pickup was vegetable prices. When you look at the breakdown, which of course can be volatile, as can all food prices be. Although this really represented the third straight pickup as well in the metric, it's hard to comment on a comparative basis over any meaningful time frame, as the prior January data did indeed see a bit of a rebase and fresh weights for inputs, whilst prior data did not account for this. What's apparent is that when looking forward, caution really does need to be stressed when looking for some takeaways from the inflation print, as the CPI has large fuel and food weightings in India, which are of course volatile metrics. And there of course seems to be several reasons as well why inflation will continue to face headwinds. Obviously, a bit of a global theme going on at the minute, isn't it? Firstly, wholesale price inflation sits in multi-year lows. There's also evidence of increasing slack in the economy, which suggests that core inflation will remain subdued by past standards over the coming months. Obviously, this comes despite the recent uptick in growth expectations, owing to new bases being used. A relevant metric to gauge this would be industrial production, which, despite beating expectations this month, remains soft over a longer time frame, with excess capacity remaining a key factor. Perhaps the most significant headwind is, of course, local fuel prices. Once again, really is a global trend at the moment, which has fallen sharply over the past few months. India, of course, has a population of over 1 billion people, is a net importer of energy products, I should say. And so this is obviously having a substantial hold on the economy and inflation going forwards. The results really should also be measured against the RBA's new formal inflation target, which was established via the new monetary policy framework. And the central bank aims to operate within a 2% band of a central 4% goal, with a cap of 6% implemented over the next 2 years, so for January 16 and January 17, with the Reserve Bank aiming to reach its 4% goal by 2018.
How could today's release affect Indian monetary policy going forwards?
Of course, the RBI cut interest rates for the second time this year last week. That was really a surprise move, once again coming out of a cycle for the central bank. Obviously, that's going to promote some anxiety from analysts and market watchers alike. I mean, one thing they like is a little bit of certainty and rigidity in structure. Obviously, going forwards, central bank surprise movements and never bode well for the markets as such, and also for possibly even accountability going forwards and credibility. I mean, just look at what's happened with the S&P in recent months. Many are looking for more cuts, however, from the RBI, I should say, towards 7% by the end of this year. And today's release somewhat questions the timing of last week's decision, as Governor Rajan stated that the decision to cut the repo rate was, of course, taken on the basis of easing inflation and promise of fiscal consolidation against a broader backdrop. Whilst the uptick is deemed a positive, the data on monthly CPI inflation is indeed too noisy for monetary policy decisions. I think it's important to keep an eye on the RBI's own quarterly survey of expectations of households. These expectations, although falling, still remain stubbornly high, just below 10%, around about the 9% region, give or take. And however, this fall does represent the first single-digit print since back in 2009. As ever, these inflation expectations will remain key. They should be heavily scrutinised, really more against the medium-term inflation movement for any signals in policy change. Obviously, I said that you're going to struggle drawing any medium-term insight owing to the back of the rebasement. So it may take a couple more months before we can really get a feel of what's going to occur on the back of the inflation movements in terms of RBI policy this year.
How will the Indian currency and RBI policy be affected by the rate hike that is expected from the Fed later on this year?
So in light of today's release, we saw a 3-month rupee non-deliverable forwards NDS gaining around about 0.5% against the dollar on the back of the release, whilst in recent weeks questions over the timing of the Fed's rate hike, most recently on the back of the strong non-farm payrolls release on Friday, has seen the dollar strengthen across the board. Obviously, the DXY broke through 100 earlier on in Asia for the first time in over a decade. However, early indicators really seem to be that the rupee should be more resilient against the greenback, as than it was in the taper tantrum back of 2013 when it reached record lows there against the US dollar. One of the main reasons behind this is that India's current account deficit narrowed in Q4 and remains far smaller than it was back in 2013. With this improvement set to be maintained, this would suggest a lower chance of a repeat of the currency crisis. However, the current account data can be quite seasonal, so it really does make sense to look at it over more of a medium-term basis once again now, typically 12 months. On this measure, the deficit widened slightly to 1.4% of GDP in Q4 from 1.3% in Q3. Also, if we include gold, it is worth noting the current account was actually in surplus, so it's shown vast improvements from times gone by and obviously reduces sensitivity to the rupee from foreign issues there. This should lead to a stronger economic policy going forward. Definitely a more stable currency and less need to attract financing from abroad also means that policymakers will be under less pressure to keep interest rates high.
Well, that's all from Anthony and myself for now. Thanks for tuning in, and remember to keep clicking back to Dukascopy TV.